Beginning in 1997, the IASB has been working to develop a valuation standard for insurance contracts. Well, after 16 years, the IASB has issued a revised exposure draft which proposes fundamental change to how insurance contracts are valued and presented in your financial statements. In addition to prescribing a valuation methodology, it also introduces significant change to how insurance revenue is presented and how profits are earned within the income statement. Direct written premiums and earned premiums are key revenue metrics today. However, the proposed exposure draft suggests that insurance contract revenue will be derived from the changes in the underlying insurance liability. Not as intuitive as receiving cash for premiums and reflecting that as your revenue over time. In addition to the presentation changes, the valuation of the reserves will be calculated on the balance sheet at market rates using a discount rate reflecting the characteristics of the liabilities, while the changes being recorded through the income statement will be at the discount rate at the inception of the policy. The difference between the two is recorded in OCI. As I'm sure you can already see, although the revisions to the exposure draft have sought to enhance the proposed methodology, it has done so at the cost of significant complexity. The IASB is seeking targeted feedback in 5 key areas, as well as wider feedback on the cost-benefit of the additional complexity and whether or not further clarifications are required to any of the proposed wording within the standard. The comment period ends October 25th, and the IASB is aiming to publish a final standard by the end of 2014 or early 15. Due to the complexity and expected transition effort required, implementation will be a minimum of 3 years after a final standard is issued, so likely in 2018 or 19, more than 20 years after the project began. Although many remain skeptical about ever seeing a final standard, the reality is the IASB does not currently have a comprehensive standard for insurance contracts today, and so it is extremely motivated to get the standard issued. At a minimum, insurers will need to gain an understanding of the impacts for their key product lines, including how revenue and profits might be impacted. Management will also need to begin educating not only themselves, but other key stakeholders in order to explain any changes from their current reported amounts, including impacts on key performance indicators. For some companies, the change is expected to be significant.